Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the data sets and the SPY for June 5th, 2025. And with that said, let me actually make sure I have the data pulled up. And we will swap screen. There we go. Alright, so yesterday, Wednesday, June 4th, we had the non-manufacturing ISM data, the PMI data. And we also had the ADP non-farm employment change. And this is the really big report that, the president tweeted about, saying that, the job numbers are terrible right now and that the Fed needs to cut rates and that the Fed is taking too long, etc., etc. But this was the big report. Um, However, we have major data on Friday that, let me take a step back. The data on Friday can kind of outweigh the data we saw today. So while the treasury markets saw yields fall a little bit on this data, we saw the CBOE um, increase their expectancy. I can't talk tonight, I'm sorry. I've had a really long day. Their expectancy on the interest rate um, uh, rate cut from 2% to 4%. So, in the grand scheme of things, that's very large, even though it's still 4% of a chance of a rate cut. And the CBOE is very accurate when it comes to pricing out rate cuts. They follow the treasury market very well. So using that as a tool is something we can generally do. Not too concerned about this PMI data. Some of the data sets came in a little hotter than the forecast, which I talked about that being, something we could potentially see. But we also saw some of it come in a little weaker. So I'm not saying it's entirely mixed. Overall, it was, a hotter data print, but we also saw, again, the jobs number come in very, very weak. So mixed data here. You have a very cool, a very calm or cool uh, data print with very hot data prints. Now let's go over Thursday. So we have the jobless claims, again, that's a weekly report, comes out 8:30 every Thursday unless there's, a holiday on Thursday or something. Uh, it'll be interesting to see what those are looking like now that we saw the ADP job report come out saying essentially, it was a whole, I think, 70,000 under the forecast and a whole 23,000 below previous. So that's very, very concerning. Um, and I know the market is very honed in on that. We do have, let's see, non-farm productivity. That's not a super, super important one. That's just going to be a revision report, so not too concerned about that. Exports, imports, not too concerned, but you can weigh the GDP off of that. So, um, while I usually don't track that, that's something I am gonna start keeping track of now because you can, really determine a lot from those numbers. Now, what is important? We have the Atlanta Fed GDP tomorrow at 1 p.m. That's going to be really huge because the last reading was extremely, extremely high. So if we see this forecasted or being at that 4.6 forecasted amount and the same as the previous, then that's very hard for the market. Because let's just quickly go over that. We were in a negative range on this for a very long time. Um, almost a whole half of a year, and then all of a sudden slowly starts pulling back to a normal range, and then it's just booming. And it's not just booming. Let's go over. Um, the maximum. This is for what? 2024. No, I want to go farther than that. Hold on. Okay, it won't let me go further than that. Let's see, show more, show more. We're just gonna keep scrolling down for a second. I believe this was one of the hottest GDP increases, though. That's what I'm really trying to get across, is that this was one of the hottest GDP increases, and it's saying that our economy is, an absolute powerhouse right now, which the data reports aren't saying that. The data is actually suggesting that things are slowing down a bit. Okay, so enough of that. Yeah, even going back to early 2024, we don't see that at all, but if you actually scroll into some of the larger charts, you'll see we haven't had that number in literally years and years and years and years and years. So, okay, enough about that. Um, so yeah, the Atlanta Fed GDP, that's going to be super important tomorrow. And then we also have Fed member Harker speaking at that time as well. Usually, Fed member Harker doesn't say a whole lot of, too much important stuff, but again, it's important to hear everything that's being said by the Fed right now, just because we are getting a lot of conflicting data. Now, I went ahead and read the entire beige book, and I went ahead and went over the summary again, and um, I took the whole summary and I wrote a small summary on that. Uh, so I'm just going to quickly go over that because I don't want to go over the full beige book. Um, Maybe in the future we can do a video where as the beige book goes out, I can, do a whole reading of it. But overall, the economy is kind of slowing down with a lot of the Fed districts right now reporting little to no growth, and there was significant I'm trying to think of the word, hesitancy and caution from businesses and consumers just across the board. Every single district was seeing that. The hiring was pretty much paused across the board. Wage growth was slowing down. Companies were seeing fewer job openings, and we were starting to see layoffs in this beige report, which that's a major concern because that's starting to say that yes, the economy is slowing down. Um, this recession thesis isn't just, totally out of the water yet. So, um, keep that in mind. The prices have been rising at a pretty decent pace, as we've been seeing with these PMI reports and everything. We've been seeing the producers increasing their prices. Um, let's see what else did I write. Hold on. Oh, okay. So one thing I did write down is that there's a lot of uncertainty behind the tariff still because the tariff, I'm trying to think of the word, I'm sorry. The pause on the tariffs have, it's starting to come up towards that date. Now, I know there's that whole CIT ruling and everything, but we can get past that if they actually write the tariffs out in a better way. Um, and I've described that in my other videos. I'm too tired to describe that process right now because my brain is just turning into mush. Um, but a lot of people are expecting prices to rise significantly higher. So come summertime, uh, we could be seeing a whole uh, 10% increase on our prices, and that's very, very scary right now. Uh, so overall, things have just been very uncertain, and the overall summary was just really hawkish for me personally. Um, Most of these beige books have been fairly dovish readings, and what that means is that the Fed has a different tone with their verbiage. They're usually softer and more hopeful in how they are talking about, whatever they're talking about, whether it's the labor market or, consumer spending, whatever it might be. This entire report was extremely hawkish for me. And yeah, I really haven't seen a hawkish beige report like that in quite a while. Um, so what that really means for the market and the economy, assuming we see that trend continue, if we do see that trend continue, that means that consumer spending is pretty much just going to drop off this summer. We will see layoffs starting to pick up. We will see um, prices very likely skyrocket for a while just to kind of make up for the lack of consumers with the consumers who actually are spending. And from that, uh, very likely we will see a recession. Now, I'm not saying that that's 100% the scenario that's going to be happening, but based on this beige book right now, that is the scenario that um, I am seeing. So that does push us back on the route of we do need to start thinking about these rate cuts a little bit more. And I actually had a conversation with a Silverliner today on Webull about this, and for me, it's we've basically been in a spot between two different paths, and those pathways are either the yields are going to absolutely absolutely spike upward because of uncertainty in the market, um, uncertainty in the economy. The just the whole credit system has been just really, really doing very poorly. There's issues with the treasury market. There is a lot of issues that can really just make the yields skyrocket right now. But at the same time, there's also the other route, which, it's kind of like going from one extreme to another. We go from stagflation to recession. And, that recession route is that we are actually starting to see a slowdown in our economy. We are seeing weakening consumers. We are seeing a job market or a labor market that is actually going to start crumbling apart. So, um, I'm not conflicted between the two, but I'm just very prepared for both scenarios. Um, from my positioning on TLT, it's like I have leap puts right now as well as leap calls. Um, I have no clue in which direction the Fed and everybody's going to be taking things right now because there's just so much conflicting data and reports and all the wars and conflicts and everything, and I am just trying not to overwhelm myself at that point. What I'm trying to get is what data is real. So for me, like reading the beige book, that's super important. That's one of the most real data sets you can read. Um, Continuing to see these job reports and everything. Are we really seeing the labor market crumbling? If we are, these job reports can't keep it hidden forever, and we will see that shifting. So what I'm really saying is just keep an open mind for both scenarios right now. And not I'm not saying that he doesn't have an open mind. He definitely does. Uh, but I think my point was misunderstood a little bit because of that. But I'm not focused on one direction or another. I think that there's a lot of validity to both theses right now, in regards to whether the yields are going to absolutely skyrocket or if we see the Treasury step in and kick the Fed out of the way and start buying back our bonds and, really just shifting that narrative. There's a lot of unanswered questions right now where it's just too soon to say, oh yeah, this is the way the market's gonna go, blah 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 blah. For me, it's just way too soon right now. As much as absolutely love to speculate on things, uh, we just have to see the data. There's just way too much uncertainty to not see the actual data sets. So anyway, I'm gonna stop rambling about that, but I did want to clear that up a little bit because I know some people think that I'm leaning one way or the other way, and right now I'm just open. I really want to see more data. I really want to see the actual direction. I don't want to be guessing and yeah. So, um, let's go ahead and jump to the technical analysis. Just a quick reminder before we get into the technical analysis. If you've been finding value in my insights, consider joining my Patreon. For just $12.99 a month, you'll get access to my trades, courses, and powerful tools to help you grow as a trader. I'd love to have you be a part of our team and community. And it's less than 43 cents a day. So if you'd like to join, click in the link in the description. Thanks. And going into the technical analysis, as always, let's go ahead and open our daily charts. Open up the moving averages and the Bollinger Bands. I'm losing my voice and I'm really exhausted, so I apologize if I sound tired as always. Now let's quickly jump into it. So we had a very weird day, but it was a very bullish day still, and I'll explain why in just a couple minutes here. Even though we closed red, it was a bullish day. The 5 mile currently is at 592.83, and because the market closed at 595.93, even though it closed red, it is still pulling that 5 mile upward. So it's extremely likely we're going to see the 5 mile being pretty much almost right at that 594 range, which means that support is pulling upward. So even though we did have a quote unquote bearish day, it still is doing the job to pull support upward. So it's not bearish at all. It also increases the gap between the 10 mile and the 5 mile, which if you're bullish right now on the market, that's what you do want to see. You want to be seeing the 5 mile continuing to push upward. And the 10 mile is at 588.81. So again, very likely by Friday we will see that pulling into the 590 range. And that's another bullish thing. That's saying that our 10-day support is above the 590 range. You know, that speaks for itself. The 20 mile is gaining significant distance on the 200 mile, so it is at 585.42. So we won't see it pull all the way to the 590 this week. I don't think. I think we will see that very likely probably Monday or Tuesday next week if the market continues on the trajectory that it's on. But that means our monthly support is heading to the 590 range as well. So again, that's another bullish signal. The upper Bollinger is at 606.51, and as I've mentioned, as we continue pushing upward, this will continue to open up. Now, it looks like it pulled down slightly, but that's just kind of how the chart is looking right now. After we get another day or two, this is going to open up significantly unless we start pulling down. But that would require us to pull all the way down to the 20 mile to actually shift the direction of the upper Bollinger. So what that all means is that right now the upper Bollinger is at 606.51. That's still an extremely good target for us, and as long as we continue to stay above the 5 mile, then that is our target we need to be looking at. Now, talking about today's action, because it was very, very choppy, and I did mention that it might be a very choppy day. And I'm going over the hourly right now. I'm actually going to drop down to the 5-minute chart because I just want to show how choppy this was. Um, this is just building liquidity. And what I really want everyone to think about is what was right under this range. And I'll give you a couple seconds. Right under that range was the upper bounds of the 5 mile. So the upper bounds of the 5 mile was basically directly at that 595 area. If you look at the low of today, it got to 595.49. So basically only 50 cents above the upper bounds of the 5 mile. That means, and going back to my example of comparing the 5 mile as to a magnet, that means that the market is actively using the 5 mile as a tool to push away from us, rather than to gravitate towards. Uh, and that's kind of what we want to see as bulls, even though it wasn't the type of day we were looking forward to. It was still a bullish day because of that. As long as we continue seeing the 5 mile pushing against us, and in this sense, that means they'll be pushing us upward, then, everything is kind of good to go. We are still looking towards our upward target of, that 609 range to all-time highs. It's really not that far away anymore. We're only, um, $15 away from that range. That's not far at all. Uh, Sorry, I'm losing my train of thought. I'm really, really tired. So, what do we look forward to here from here? Okay, so I know everybody's starting to get incredibly bearish because the RSI on the daily, and I don't have it on my chart on the computer, but that's starting to pull really, really high. It's starting to show people that, um, you know, technically you should start shorting this because all the indicators are saying that we're going to start pulling downward. Um, that's not exactly the case. What I'm looking for is for whether that 5 mile becomes something we gravitate towards or continue to be pushed away from. And for me, that's the biggest signal right now, because as many of these, uh, you know, really weird rally pumps have gone in the past, they can really just crawl this up on no volume, and just barely hover it above the 5 mile range. And that's what they've been doing the last few days. And that's why I've been really just looking upward towards the all-time highs because it feels very similar to the price action that they used to push all-time highs, in the past. And I've seen the all-time highs push multiple times, trading throughout the last few years. So I do have, a little bit of experience with that. And that doesn't mean that I know everything, of course not. But that's why I'm really looking upward. For me, the moving averages are positioned to be bullish. We have the 5 mile above the 10 mile, 10 mile above the 20 mile, 20 mile above the 200 mile. That's exactly what you want to see. The only slightly bearish thing right here is that the 50 mile is below the 200 mile. That's really it. The other only bearish signal right now is that the RSI is, quote unquote, overbought. But if this is a fair value gap fill, which I believe it is, that means this entire selling for the, um, I can't even think of the word right now. The sell off, the correction, that's what it is for the correction. Um, it's very likely all this massive buying you're seeing is just that money being placed back in, which means that this isn't overbought. That, there is still a lot of room before we even really see the buying kicking in. And I know that kind of freaks some people out, but we could push to all-time highs before we even really see the real retail buyers kicking in. Um, and all the market has to do is just continue pushing that 5 mile, continue testing that 5 mile, and as long as we continue to keep the moving averages bullish, then we're going to continue heading upward. Uh, so let's just go over the bounds of the 5 mile for tomorrow because that's kind of the ranges we need to look for right now is either the upper mile or the 5 mile. So the bounds on the 5 mile is very likely we're going to see the 5 mile at the 594 range. So that means the upper bounds is very likely going to be in that 596 range to 597 range. With the overnight price being at 595.61. Technically, we're doing the exact same thing we've been doing the last two sessions where we kind of uh, test the liquidity in the upper bounds of the 5 mile during the overnight and the pre-market, and then we just, you know, move away from it from there. So the upper bounds again, the 596 range. The lower bounds is going to be in that 590 to 591 range. So tomorrow, if they do want to do a whole nother 5 mile test, which I really don't think they will, but they can, then that means that technically we can go all the way from the 597 all the way down to the 590 and it could still be very bullish for the market. So as always, just prepare the 5 mile as you would any other time and again, set up for the upper Bollinger and set up for the 20 mile. Don't overcomplicate it. You don't have to overthink it. Um, Now structurally, really quick, let's just go over structure here. Potentially we do have a cup and handle and let me go ahead and pull up the drawings so I can actually draw for once. So we have the cup right here. Oh, my mouse slipped. Okay. So we have the initial cup. Okay. From that cup, we had bearish structure. Okay. From that bearish structure, pulled down to form a handle to form bullish structure. Okay. From that bullish structure, we completed the cup that is within the handle. So it's called a nested cup. Okay. And from this nested cup, so far, we have a bear structure. Okay. So what we should be looking for from here is another bull structure to form within the handle, and then the breakout. And that's really as simple as it gets for the bull thesis. I can't talk. For the bull thesis, um, let me just go ahead and change the colors on these just to make it more visible. But everything is set up right now for major bullish liquidity. This is the exact type of liquidity you want to see all-time highs. Even though the volume and everything has been very slow and it seems like it's going to fall off a cliff, don't underestimate how bullish this structure is right now. It's very likely we see this small head and shoulders give us our handle, and from that handle, the breakout. It's looking like the bottom of the handle will be within that 5 mile test range, so that's why I'm kind of suggesting that potentially we could see that 5 mile again. But if not, then we look for this to kind of form a cup in here, and then from that cup, a handle into the breakout. So, no, I'm not very bearish right now. I do expect some downside. I do fully anticipate it to be kind of bullish liquidity, meaning that going down is to be pushed upward. The ADL has been very strong, and it does look like to me personally that we are going to break out of this major selling channel and we're going to head to all-time highs. That's been my thesis for the last few days now. So far, the market has just been slowly pushing upward and slowly validating that thesis. So I think, we just continue going with it until they show us signals that it's starting to break. And so far, we're not seeing that. So, Okay, I'm really exhausted. That's enough rambling from me. I hope everyone has a great trading day today. Don't overtrade these chop ranges, just wait for the actual breakout and take contracts on that. Set up the 5 mil. No need to overcomplicate it and play short duration stuff into this. Um, anyway, with that said, trade safe tomorrow. Have a great day, and I will talk to you in tomorrow's video. Have a good one.